Good morning, everyone, and thanks for being here. My name is Addison Snell with Intersect360 Research, and thank you for joining me for this HPC Market Update webinar presentation. I'm sorry that we're not meeting in person somewhere out on the conference circuit. We normally like to do these at a major conference such as ISC or the like. Here I am in my home office in Silicon Valley, California, and we thought we would bring this market update out to you wherever you are, and appreciate you tuning in. And this has been an important presentation because this is a difficult year for market forecasting, of course. As analysts, a big thing that Intersect360 Research does is take a look at the trends in the market size, market shares, and then a 5-year forecast of where we're going to be over the next several years. We're in the middle of a very special year, of course, with the global pandemic that is having a significant economic effect worldwide, and that's put some pressure on our ability to do a 5-year forecast. We're going to get into the details of some of that over the course of this presentation, but right off the top, I'll say that we're seeing a negative effect already on the previously forecast growth for 2020. That's going to get wiped out according to our forecast, and we're heading toward our first decline in the market in over 10 years since the last recession in 2009. The good news is that most of that shortfall will come from sales that are delayed rather than canceled. And therefore, after a down year in 2020, we forecast to see a rebound year in 2021, and then it'll continue to wiggle a little bit in 2022, 2023 before it levels out again in 2024. There will not be a very large change to the overall 5-year growth rate, and by 2024, we should see ourselves pretty much back on the line that the industry would have been on, although there are going to be some significant market effects over the course of that time period, and we're going to talk about all of that over the course of this presentation. I am going to take live Q&A at the conclusion of the presentation. I'm not going to stop along the way just because that's a little bit more difficult in an online webinar format, but we are monitoring your questions, and I'll do my best to answer as many of those as I can at the conclusion of the presentation. This is data now that has gone out to a lot of our clients who subscribe to our high performance computing market advisory service on an annual basis. We publish full written reports on the size and forecast of the market in several segmentations. 4 of these can already be found on our website. The one that's thought of often as our primary segmentation, which is products and services, that divides HPC market spending into servers, storage, networking, cloud, software, the major components of spending. We could also potentially look at internally spent items on things like staffing, facilities. Those aren't normally part of what we would consider a market size because they're not spent externally. That's more of a total budget view. We do track that as part of our budget surveys in the market. We're very grateful to the users who provide us this data. And that actually is relevant here because it has to do with the trends of how a budget shortfall percolates through those different categories. So I'll talk about that a little bit, but really that's more part of our budget map survey series reports that we'll publish later on. We have run that survey. Another segmentation that's already up on our website is vertical markets. This divides into the different categories of users who purchase high performance computing infrastructure, and that's particularly important this year because this is our primary forecast that we looked at for the lens of what are the effects of COVID-19. As we did the analysis, we saw that the pandemic was really going to affect different vertical markets in dramatically different ways, and we're going to touch on that also over the course of this presentation. We also take a look at market shares by revenue for both servers and storage. Those are the cleanest in terms of actually looking at market shares. Those are not forecast. We report on those for the current year and previous year only, so we look at year-over-year change. The reason we don't forecast those is, as analysts, we don't want to have a competitive effect on the market by saying we think vendor A is going to start gaining on vendor B. That becomes consequential or causal rather than just being predictive. So we stay out of that game so that we don't accidentally endorse one vendor over another, but we do report on those vendor shares, and we will talk about those in the course of this presentation also. We have the data complete for the other major segmentations for the market size and market forecast. That includes geographic regions and then subcategories of server classes from entry level up through supercomputer, software categories of spending, services categories of spending, cloud categories of spending. Those reports will hit our website later this month, and we do already have that data. We'll discuss it in this presentation. That data has already been provided to our clients. So thanks very much for tuning into this webinar, and I'll dive into some of this overview, starting with 2019 versus 2018. Now, the good news here is 2019, before the pandemic really got going, was actually a strong year. Worldwide HPC spending was $39 billion in 2019, and that was 8.2% growth from 2018. That was about a percentage point higher than we had forecast. We'd forecast in the low sevens. So the market outperformed our previous forecast in 2019. The big highlight was that government led the growth in the government sector, was the growth leader on a percentage basis, 2019 over 2018. It had been driven by industry for the 6 years prior to that. This was the first time in over 10 years that the government sector had the highest growth rate. This is really a relaxation of years of different forms of government austerity programs in different regions around the globe. And we project that that strength in government spending will continue through the forecast period. Now, there were very uneven distribution according to how we can look at the products and services. I think the big things that people tend to look at, the on-premise servers and storage, that was much more modest growth, each of those between 2 and 3%. So those are actually a little lower than what we had forecast, but that was compensated for by major growth, not only in cloud, which we had expected, and that's still coming in at strong double-digit growth rates, but what we might term as cloud-like sorts of deployments. In addition to the expected spike in cloud, we saw unusual patterns in different sorts of categories that could be marked as other. Not only the other, but software, other software, services, other services. And when we dug into those at the budget level, what we found was a lot of things like managed services contracts or facilities outsourcing, or other forms of abstracted or utility computing types of deployments that are paid for through a service provider or through a software provider in a way that is cloud-like, but not strictly public cloud consumption. And our survey, as it's been written, just didn't accommodate a lot of a neat place to put that in terms of how much of it we saw growth in 2019 or over 2018. So for now, we've kept it in the categories where it showed up. The result, or where it came from, is these managed services, facilities outsourcing, other types of cloud-like deployments. And we're going to take a look at how we structure the budget survey going forward to see if we can categorize those a little more neatly in terms of these different sorts of service level deployments. Another major trend that we looked at that we'll talk about here is that in the major categories for market share, servers and storage, the top vendors tended to decline in market share. And what we saw was growth going toward more specialized vendors, smaller vendors, regional vendors. That was where we saw all of the growth. Not so much that it knocked the top vendors off the top, but it was an undeniable trend from 2018 into 2019 that I think is continuing in 2020, where we're seeing some of the smaller vendors show more of that growth, and we'll discuss that over the course of this presentation as well. Products and services, this is, as I said, often the first segmentation that we tend to look at. You can see that the server component or compute component tends to be the largest part of the market, although it's been having for a few years one of the smaller growth rates. That has continued to grow. We did see growth across every one of these segments, 2018 to 2019. Cloud, of course, which is the one second from the top in that orange, did have extremely significant double-digit growth, but that's still coming from a smaller base. And when we look at the growth in other, the growth in services, that was where we saw a lot of the growth really take up from this part of the market. Now, when we look at cloud, that can include things like managed service providers, organizations like Rescale or Nimbix, HPC, Uber Cloud, in different geographies that can provide cloud services for HPC, but aren't necessarily acting as the end cloud provider themselves. In some cases, they pass that through to another provider. To the extent that that looks like managed services or another sort of arrangement, that's where some of that spending can essentially disguise growth in cloud as something else. That's one way in which that can happen. Federal systems integrators are another way, to the extent that government is managing growth in HPC. Some of that is actually on premise, but you see a managed services contract going to a major government provider and it gets logged as services or something else because the contract goes through a major federal systems provider, someone like, say, General Dynamics or CSC, Lockheed. There are many of these. I'm not trying to call out any one of them specifically, but those federal systems integrators also played a role, especially as with the growth that we saw in government spending this year. Some of that doesn't show up on the hardware line. It depends on how the end user is categorizing those expenditures, and when they show up as services, we're reporting them as services here. When we look at the revenue market share for servers, the leaders here are and have been for several years HPE and Dell EMC. Those combine for 60% share, and there is a near virtual tie for number one here. HPE has been ahead by about a percentage point. That gap has declined to where it's now less than half of a percentage point in our model of HPE still is number one ahead of Dell EMC. So as much as I know HPE wants to claim number one in servers, and they can, they're number one in servers based on our numbers, really the high level guidance we would say is there's almost a co-number one between HPE and Dell from a server standpoint. They each have about 30% market share at about $4 billion of servers each, and that's pretty evenly divided. This includes for HPE the Cray revenue from post-Cray acquisition. You see we're not reporting Cray on this chart here, and that will have given them a little bit of a bump, but remember that deal only closed in late September 2019. So it had the effect of giving HPE about 14 weeks worth of revenue from Cray, and that acquisition was not fully realized in terms of a full year of revenue in 2019. HPE should get more of a bump from that in 2020 as a full year of Cray revenue starts rolling into HPE's numbers. In terms of Cray revenue prior to that, Cray had a partial year of revenue. It did report publicly in Q1 and Q2. It did not report publicly in Q3, although it did continue to sell in early Q3. That revenue, to the extent that it exists, is in the others category here, and others did see a bump from that, as well as for other reasons, just in terms of smaller resellers and smaller vendors not shown here, also growing on this chart. Lenovo, which is the third largest server vendor by revenue, was the largest revenue that showed year-over-year growth, and it did in both servers and storage. IBM also had decline. That's a little bit of a disappointment. IBM had grown 2017 to 2018. I think riding some of the halo effect from the large-scale power-based Coral servers. They did not sustain that into 2019, and IBM saw a decline again after that. Following that, every other vendor that we count specifically all showed growth, and some of it was really significant double-digit growth. Atos in bold here led the way in terms of the highest growth rate among the vendors that we're counting. Atos is, of course, known by the Bull brand through a lot of HPC and supercomputing. Atos uses that brand still, so that's Atos, Bull, same company. We're reporting them here. That was the largest growth rate. It's worth noting that Fujitsu just put in the Fugaku supercomputer Riken this year, and often what we see is that a major supercomputer like that does have a halo effect down into other types of HPC sales over the course of the year. So it's presumable that Fujitsu could get a bump from that, but like I said, we don't forecast specific vendor shares going forward. That would be presumptuous of us to do that. But Atos, Penguin, Inspur, Fujitsu, all of those showed very strong double-digit growth. Huawei even showed growth this year despite the fact that they had significant trade and political issues with the United States. Huawei is very strong internationally, including in China, but not limited to China. And despite the woes with the US, Huawei did grow year over year, 2018 into 2019, and that just shows how much of the market is outside the US. I do want to say within that others category, there are some notable companies here. Supermicro is probably the biggest vendor that's not specifically called out on the list, and probably bigger in true market share than some of the vendors we do list. The reason we don't call them out separately is because such a high proportion of Supermicro's revenue is resold through other vendors that it's difficult for us to get a true market share on direct sales from Supermicro. What I mean here is, as analysts, we're trying to assign the revenue to only one vendor so that we don't double count it. If Supermicro's if a different vendor had an OEM or reseller arrangement with Supermicro and sold that server, we don't want to count it twice, giving it to both Supermicro and the other vendor, whoever that is. And in our model, what we do for market share then is we assign the revenue to the end seller of that product. That has more of an effect in storage than it does in servers. And we'll talk about that on the storage slide in a minute, but within servers, Supermicro is the vendor it affects most strongly. We would estimate that more than half of Supermicro's revenue actually goes through other resellers, and because it's difficult to get a read on how much of Supermicro's revenue to leave on Supermicro's line versus moving to someone else's line, or that it's already accounted for on someone else's line, we keep Supermicro in the other category for now because it's harder to count, but they're certainly a notable vendor in this space. Shugon, previously known as Dawning, is also a noteworthy vendor here, but their sales are primarily within China and primarily to Chinese government organizations. And what guidance we get from them, we're not sure how to categorize that. It's difficult to count. I think a lot of it is hidden. We don't have enough confidence in the precision of that number to put it on our chart, so we keep that in other as well. NEC is another noteworthy vendor here with vector-based systems coming out of Japan. We don't call them out specifically. And then I've got NVIDIA in bold here because we normally think of them as a chip vendor, of course, and they've been a huge vendor of GPUs. They had another strong year, year over year, 2018 into 2019. We don't typically report market share of processors because a lot of that market share, it really gets hidden by the servers. They're a component of the server spending line, and the money earned by the processor vendors tends to come as a payment from the server vendor. So it's really hard for us to track revenue share from an end user spending perspective. We do that from an installation perspective as part of our site census surveys. That's not the focus of this presentation here, but certainly we've seen very strong GPU growth in the servers, and NVIDIA's had a strong year. But the reason I've got them on this chart is because now they're selling DGX systems, including HGX reference systems in all the different configurations. I'm not trying to limit that to DGX2 or whatever, but I'm just saying the whole DGX, HGX line, including now SuperPod configurations. We've seen the Selene supercomputer in the top 10 on the top 500 list now. Now that's for 2020, not previously, but to the extent that NVIDIA has become a server vendor of these systems, they're in the other category here as an interesting new entrant, and we're going to have to watch whether we want to start calling them out in terms of server revenue and what their server market share is going forward. Clicking now over to storage. Storage does have a clear leader, and that is Dell EMC. This is storage for the HPC market. And anytime I talk about HPC storage, I have to be very clear that what we're talking about is all storage that people are paying for out of HPC budgets that run HPC applications, that store data for HPC applications. That does not have to be storage that is specifically designed for high performance computing in mind any more than it does on the server side. Someone could buy non-differentiated enterprise servers and build a cluster out of those, and they become HPC servers by nature of the fact of what's running on them. HPC storage is much the same. And the reason I call it out here, excuse me for just a moment, the reason I call it out here is because we see a higher proportion of storage really going to enterprise storage vendors that don't necessarily target HPC applications with all of the configurations that are going into these HPC areas. And it's not that Dell doesn't target HPC. Of course it does, as does EMC, and they have high performance products. But Dell EMC's market share lead here is just built on the vast array of EMC storage that exists across enterprise, and they have a lot of top-level enterprise contracts to provide storage at an enterprise level through the market. A lot of the strength comes from that. It's not just the portion that's Isilon or PowerVault or what have you. There's a lot of storage that goes through here. I'll also have to mention that there's all types of storage within this. There's spinning disk, there's flash, there's now NVMe in the market. We even endeavor to count archive storage, although that does get tricky because when we survey on HPC, the end user doesn't always think about the archive as a significant part of HPC revenue, although certainly it is part of the overall storage budget. Now, the top 4 vendors on this chart, Dell EMC, HPE, NetApp, IBM, all lost a little bit of revenue from 2018, although they still combine for 60% share overall between those 4 vendors. Dell, HPE, IBM were all down slightly. NetApp had a poor year. NetApp fell more than the rest of them did, and that dropped NetApp, excuse me, that dropped NetApp from the number 2 market share position to the number 3 market share position behind HPE. It's important for me to emphasize that's not based on growth from HPE. HPE also declined a little bit. NetApp declined more, and that fell behind HPE for that storage. Now, some of that might be a mirage. As I said earlier, NetApp was the largest vendor that grew on the server line. NetApp also grew on the storage line. In late 2018, Lenovo announced a partnership with NetApp to resell NetApp storage under Lenovo brands or directly through Lenovo sales channels worldwide, particularly with a joint venture in Asia and China, although that targeted a hyperscale perhaps more than HPE, but it could have an influence. So some of Lenovo's growth here could, remember what I was saying before about assigning revenue to only one place, some of Lenovo's growth here could come from NetApp storage. So that served to amplify what was probably a NetApp loss anyway, but NetApp's loss shouldn't have been as deep as it shows up here because some of the revenue moves over to Lenovo, and NetApp is still a strong provider in this space. What I mean here is don't get alarmed by a big drop in NetApp. Some of that revenue is showing up somewhere else. And NetApp is probably just more in line with the slight decline that we saw on the large vendors. As more of the vendors go, more of the market share, excuse me, goes to the other vendors on this chart. Now, DDN is often thought of as a leader in HPC storage. What they are is certainly the largest vendor whose market is predominantly is defined by high performance storage. They sell high performance storage. That's what they do. That's the market they're in, and they're the largest vendor that does that. They had very strong double-digit growth year over year, and in fact, even better than what you would see here year over year on our charts, because the other major grower was Atos. Atos, in fact, led from a percentage basis in both servers and storage. But when we come to storage, a lot of the Atos storage is resold DDN product. So if we're assigning it to the end seller, it's Atos, but DDN also gets a bump there as well. Some DDN growth is actually on the Atos line. Fujitsu also had double-digit growth and is specified here. We used to track Hitachi Data Systems, and Hitachi Data Systems does have a revenue share that could show up here, but we've moved them to others due to a lack of focus on high performance computing and a lack of specificity in their numbers. Now that they've fallen below 5% of the market, because they're not really targeting HPC, it's just harder for us to call out specifically what those numbers are. Other noteworthy companies here, there are many. Some server vendors like Huawei, Inspur are also on this chart, are also in this market, I should say, but their storage share sold by them is small enough that we don't have enough specificity to put it on the chart. Panasys is another company that, like DDN, really targets high performance storage specifically, and they had a growth year over year, but their numbers are just a little too small for us to put on this chart. Quantum, Cumulo, Weka.io, all in that same category of high performance storage. Spectra, from an archive or tape perspective, we could look at their share. So it just gives an idea of the breadth here. And whereas I call that NVIDIA as a notable other on the previous chart, here I'll talk about Intel. Intel, of course, is in the same bucket with NVIDIA in terms of being a dominant processor vendor. In fact, much higher in overall revenue or sales than NVIDIA is from a total revenue perspective that way. But here what we're talking about is storage, and for Intel, that's notable because of the Optane product line, all of that NVMe or flash storage that's now going into servers. That was a major growth category, and I think it's going to continue to be a major growth category. So we have to see what Intel continues to look like in terms of the growth in storage, and whether we want to start reporting on Intel as a storage vendor in this market. But that's been a significant product for Intel over the course of the past year. Vertical markets, as I said, is an important categorization here, moving beyond the products and services. And I have gone ahead and put percents on this chart for 2019. First of all, we can look at this at the sector level, and it's important to realize that from an economic sector perspective, the industrial or commercial use of high performance computing is and has been more than half of the market. And that's been the major driver of growth for 6 years prior to 2019. Still grew in 2019, but government had the highest growth rate in 2019 and is now a little over half the market. Academia is one big portion at 17.1% of the market, and we don't divide that up any more finely than that within academia to say, well, here's academia doing energy research or doing biosciences or genomics research or climate research or what have you, because the vast majority of academia is mixed use research labs, and you buy one computer and run a lot of things on it, or or even when it's separate computers, one university will buy a lot of different computers for different things. And again, it's difficult to divide up from a budget perspective. So we leave academia in one chunk. If you want to talk about workloads in academia, we do that as part of our software reports out of our site census survey, so we can look at that. But from a revenue perspective, we just keep academia together in one big wedge there. Government divides between national security and national research labs for the most part. National security is one where the United States tends to dominate the spending, although it doesn't have to be US only. This is important for any government spending. Remember, this is a lot more than the United States. Other companies have governments, other companies' governments spend money on high performance computing, and that's all reflected here. National agencies are another category. Our distinction in our research between national agencies and national research labs really comes down to one of focus. National research labs we tend to think of as being general research, something like HLRS in Germany or Oak Ridge National Laboratories in the United States. They touch a lot of different types of workloads, and we report those in the national lab category. National agencies is our designation for having a single point of focus. The most common things here are weather facilities, something like ECMWF in Europe or NOAA in the United States. Those are single focus, and therefore we would put them in the national agency category. It doesn't have to be weather. National Cancer Institute would be another good example, or something like NASA or JAXA from space exploration or aerospace deployment. Those would go into national agencies. And then there's even a little bit for state and local government. It's not really 0%. I'd call it rounds to 0 point something that's on the chart. And that's actually growing through analytics and some other areas. We do not call out weather as a specific vertical market because it's not a vertical market. It's an application workload that could be run by a national agency. It could be run by a national research lab like an Oak Ridge, like I said, or an HLRS. They could do weather or climate research. There are national security concerns like Fleet Numerical of Monterey under the US Navy that do a lot of weather research. There's a lot of weather research in academia. There's even weather research that's in the commercial side. So weather is an example of something, or like computational fluid dynamics is another good example of something that we don't break out because it's a workload, right? So we do research on those, but again, that tends to be on the software side out of our site census survey. And those of our clients who are interested in those sorts of reports, we actually have 11 different reports of 11 different types of application domains, or we break out the top applications in those domains. How much is open source versus in-house versus commercial licensed applications, how we view them by sector. Those reports are all also available, and we do that research. But here from a revenue model, we don't break those out separately. Looking at software from a revenue model can be tricky because a lot of it is free software, and something that's free has 0% revenue share by definition, no matter how many people run it. So that gets a little tricky on software. That's why we do that out of the survey side rather than out of the revenue side for those reports. Going over to commercial, you see financial services there on the top. Whether the top vertical market by revenue spending for high performance computing on the commercial side is financial services or manufacturing is a matter of taste, because you see two different manufacturing vertical markets on here. Large product manufacturing, which is really mostly automotive and aerospace, the auto companies, the airplane companies, and also large equipment like, say, a Caterpillar or something like that. The ones building big things, those go into large product manufacturing. Then there's also a consumer product manufacturing category that's on the chart. That's going to be people who make everything else, bicycle wheels, golf clubs, diapers. Procter & Gamble has been the poster child in this space for a long time, but it goes well beyond P&G. That's been a big growth area in high performance computing as well. So that's the question. Is that one vertical market because it's all manufacturing, or are Procter & Gamble and Toyota two different things? If you like that as one manufacturing vertical market, then that's the biggest. It's a little bigger than finance. Some of our clients like separating those out, which makes finance the biggest. We report them separately here. Some of our clients put that back together. That's up to you. It does make it a little complicated in terms of which is the largest commercial vertical market. That's all. Chemical engineering, I'll go around the wheel here. Biosciences, that's a catch-all for a lot of different types of vertical markets. The largest one in there really is pharmaceuticals, but that's similar enough to things like commercial genomics labs or agricultural engineering that we tend to group them into one biosciences category here. That's going to be the most stable commercial vertical market over the course of the forecast, and I'll come back to that when we start talking forecast. Energy is, of course, mostly the large oil and gas companies. That's been struggling right now already with a low price of oil, and we'll come back to that in the forecast as well. But we saw one of the lower growth areas in energy as they were already struggling with a low price of oil in 2019. As much as we like to think about HPC driving future revenue, which it does, spending today, the biggest influence on spending today is how much budget I have. The biggest influence on how much budget I have is how much revenue we had last year. And that goes across all of commercial markets. So when revenue goes down in one year, we tend to see HPC systems get depressed the following year just because budgets go down, and that's the way things are. And that's going to be a big part of what we're talking about in the forecast for 2020. Retail, you see on the chart here. Now, most of retail spending on things that are really scalable go into the hyperscale market. And I haven't talked about hyperscale at all here. Those are going to be the very large cloud scale deployments or internet scale deployments. Doesn't just have to be for cloud specifically. Take Amazon as an example. Yes, they do AWS and they buy a lot of systems for AWS, but that's actually a minority of the overall resources they purchase to do their retail and Alexa and all kinds of other products, right? Amazon is a vast company, and it's hyperscale companies like that that form our hyperscale methodology. So there's a lot more in retail systems. I should say hyperscale systems supporting retail is bigger than HPC systems supporting retail, although we do see HPC in retail for things like high-end analytics. Think about, again, I mentioned P&G as a poster child in consumer product manufacturing. Walmart was a perfect example of this for a long time in terms of being on the early end of doing HPC for advanced analytics for things like logistics and product placement and consumer behavior. There are real HPC applications in there, and we do see them in retail, and we continue to measure it there. Chemical engineering, which we finally expanded the label on from just saying chemical because it was confusing that between biochemistry. Here we mean chemical engineering like plastics and polymers, Dow, DuPont, 3M, BASF. BASF actually has the largest supercomputer in this space right now. They're interesting because they're in a high growth mode right now as we see more HPC systems transcend operations and manufacturing on the production side and go into the scientific understanding of these, of the molecular modeling and so forth. We're going to see that in a higher growth mode. Media and entertainment is interesting here, again, because this used to be a bigger HPC vertical market several years ago, but first of all, things like rendering, which used to require HPC systems decades ago, they just don't anymore. Rendering is not an HPC application. It fell out of it's the rare application that didn't get more complicated as fast as systems got more powerful, and rendering just, we don't consider it an HPC application anymore. Also, digital content creation and distribution, not really HPC. That's a hyperscale application. So things like serving out movies to vast numbers of subscribers, which can be done over the internet, can be done to your cable box. That's a hyperscale type of application. We count that as hyperscale. Nevertheless, there is still HPC in media and entertainment, particularly in high-end visual effects and physics calculations. Could even go into video games, where we see calculations to say, what should this explosion look like? There is HPC in those areas, and we count that there. Electronics is the EDA market, and I don't have a whole lot more to say about that. Transportations has some logistics applications, and then there's always a ubiquitous other categories. So we continue to monitor all of these on a year-by-year basis. In most years, we don't see a dramatic change between these. This year we will, because there are going to be vertical markets that are significantly harder hit by the COVID-19 pandemic than others, and I'll come back to that in the forecast section of this webinar. Global regions hasn't changed too much, but the bigger growth in 2019 has been outside the US, which contributed, I think, to growth of non-US based vendors. North America did show growth, but the higher growth was in EMEA, Asia Pacific, Latin America. North America, which is to say really US plus Canada, because things like Mexico, Central America, which are technically part of North America on a continent basis, those are reported as Latin America here. North America is US plus Canada, is now less than half of the market and declining as a proportion overall, which is to say the growth is concentrated more in the other areas. It's not that North America is spending less year over year, but the other geographies are growing faster. And then server classes, 2019. The important thing here is that we're seeing the growth concentrated to the higher end of the market. We define supercomputers primarily as systems that have a price point over $1.5 million. That's a different categorization than another analyst might use, but we think is appropriate to this part of the market. The point is that the growth has been higher there and lower down at the entry level. As you go down in price, the growth has been lower. A big reason for that is that cloud computing naturally draws a little more heavily from entry level and mid-range than it does from high-end and supercomputer. The further down this chart you go, the higher a pull you see from cloud computing. So that is to say that a lot of the growth rate is disguised. It's just not showing up in servers, it's showing up in the cloud line, and we think that will continue. Software and services categories for 2019, I'm not going to spend a lot of time on, but on the software side, system software, we actually saw a decline. That's going to be mostly the operating system and things that go into the base operating environment. The big growth was in some of the interesting areas like other and transfer costs. Transfer costs is when I pay another division of my company for developing the software that I run. So again, things like outsourced private clouds, or rather I should say insourced private clouds, where I'm paying an entirely different division of my company to set up my cloud and then I pay for it on a utility basis, could be showing up under transfer costs. If I pay a software vendor for software as a service that then gets consumed in cloud, that could show up as software other. That's where we're seeing big growth. On the services side, there's big growth in a lot of areas, but other is the big growth. That's going to be managed services kinds of contracts. Programming services, system integrators are also all up. So that's just underlining that theme that I mentioned earlier on, that the big growth is in these other areas. And when we dug at them, what we found is cloud-like sorts of deployments that aren't strictly natural public cloud. Cloud categories themselves, the big growth areas were in raw cycles and storage, and not so much in environment hosting, application hosting, IaaS, PaaS, SaaS, which is to say what that suggests to me now was that in 2019, when people were just looking for the cloud services, I know what I want, I'm going to go buy the instance and run it, that they went directly to the cloud vendor for it. But when it got more complicated into IaaS or SaaS, that people were more looking at either a cloud managed service provider or some other sort of cloud-like arrangement that might not have been directly with the cloud vendor themselves. That was some growth there too, but we saw a lot of growth in those other areas. This actually means that what we're seeing is that the cloud space in HPC is maturing. There are more different ways to consume high performance computing in the cloud. And overall, what that means is that HPC cloud is growing. There are going to be a lot of different ways to buy that. And we're going to continue to watch that, especially this year as cloud is going to be significantly affected in the opposite direction by COVID-19. So I've been setting up that forecast for a long time. I'm going to get to some of these forecast charts as we look at 5-year forecast 2020 to 2024, including effects of COVID-19. Often when we do a forecast, we're just saying, yeah, here's the growth rate out there, and we're going to see things that are generally pretty smooth. That's not going to be the case here. Now, at the top level, the worldwide high performance computing market is going to continue to grow, and we should touch $55 billion in 2024. That's a 7.1 compound annual growth rate from 2019. Year over year, there's going to be dramatic variability between those things, and that points to a bit of a vagary in terms of how compound annual growth rates work. As long as you hit the same endpoint at the end, there's not really a change in the compound annual growth rate. Cloud is going to be a major contributor here, continuing to grow over 20% compound annual year over year, but again with dramatic variability year over year and have a major effect on the market. The government sector has the highest growth over the next 5 years on a CAGR basis. The server revenue growth is going to continue to concentrate into the larger configurations. That's, again, partially as a result of cloud. So we're looking at the on-premise HPC server growth. That's also fueled in part by exascale computing, which is one of the drivers of government spending, and partly because the lower end systems have the higher replacement by cloud computing. Now, we've got to talk about COVID-19 because this is having a huge effect on revenue over the next 4 years, including lost revenue that won't come back. But by 2024, we're back on more or less the original growth curve that we would have been before. And that means that COVID-19 doesn't have an effect on the compound annual growth rate. What it has a short-term effect on is year-over-year spending. And here's what we mean by that. Now, hazards of forecasting. This is my favorite thing my partner, Chris Willard, ever said. He's our co-founder at Intersect360 Research. When you make a forecast, it has to be bound by what's realistic. Reality has no such restriction. That's never been more appropriate now than it is this year. What it means is we don't forecast things like wars and droughts or pandemics. When we did our forecast in 2019, we didn't say, you know, there's going to be a pandemic and that's going to affect the market. Now, here we are in the year that we're having, and it's worthwhile for us to look at what we think the effect's going to be by vertical market. There is risk in this forecast. And right now, what we're assuming is that the economic effects of the pandemic are predominantly constrained to this calendar year, or at the very least early 2021. To the extent that the pandemic has a lasting economic effect, a deleterious economic effect on international markets into 2021 to cause a shortfall there, we're going to have to start over, right, if that happens. Right now, what we're really forecasting is if the pandemic has a business effect that is predominantly constrained to 2020 or early 2021, that the market then starts coming back after that, and we're going to forecast the short-term effect. That's the presumption that we're working from here. This is the shape of what this looks like. The good news is, well, not necessarily good news. Good news if you're a forecaster is that we've seen this before. We know how to look at this. And the shape of this generally says, if we start from pre-recession, year zero, in this case, that's going to be 2019, what we're basing this on, and we look at what would have been the smooth growth curve beyond that. That's our baseline pre-recession forecast growth rate, although they've all got independent growth rates, right? We forecast every product and service segment, every vertical market, entry level up through supercomputer, every region, all has independent growth rates. What you see on our charts are are roll-ups of everything that goes into that. And they tend to look smooth, although you'll see some areas like cloud computing clearly has a higher growth rate than everything else. But let's take the market as a whole. It tends to look pretty smooth. What happens in a recession is this: the underlying demand for high performance computing is still there. People still want to run the high performance computing. But what happens is in year one, what you see on that chart that's labeled year one, you have a significant budget shortfall. That causes a dip. Now, most of that spending is delays more than cancellations. So then what happens is you get to the year two, and you get all of the spending that you would have had in year two, which is the third column here. I'm counting 0, 1, 2, okay? And you get not only the money that would have been spent there, but also you catch up a lot of purchases that would have been, that are delayed from the prior year, go into the next year, and you get a spike. And when you go from a year that's artificially low to a year that's artificially high, you get this artificially high growth rate where you say, wow, where did that huge double-digit growth rate come from? Well, what happened was you delayed purchases from one year into another. You essentially had a year that had maybe only 8 or 9 quarters worth of spending in it, and then the next year has 12, 13 quarters worth of spending. I'm sorry, excuse me, 15, 16 quarters worth of spending in it, and you have an artificially high year. Then in the next 2 years, we actually get an echo effect that's smaller. And this has to do with product cycles and budget cycles and people tending not to buy things in back-to-back years or staggering them out. So you go a little lower in one year and a little higher in the next year. There might be a dip from year 2 to year 3, or it might flatten. It just depends on the severity of it and how we're dealing with the growth rates. But the point is there's a little bit of an echo effect, and then by the 5th year in the forecast, you hit the growth rate where it would have been before. We've seen this before. This is basically what the market looked like in the years following 2019, or following 2009, which was our last recession that we tracked through this. And we also saw a similar effect just within the HPC storage category after supply chains were really disrupted by tragic floods in Southeast Asia in 2011. That messed up the spending there, and then we saw catch-up years. We saw a similar pattern. We saw that and measured that in our numbers. This is actually what happened in the 2009 recession. I kind of put an orange line there to approximate what smooth growth might have looked like. And what happened was 2009 was depressed for the recession. 2010, we caught up above the line. 2011 was sort of back to the line. 2012 was above it. 2013, we're on it again. So there's always going to be variability year over year, and no model is going to be perfect. This goes back to what Chris says about reality has no such restrictions, but this is very close to what we just showed on the previous chart, and it's how we're forecasting the market is going to behave over the next several years. So our model, or how we approached this, was we did the forecast as normal using all of the data we had about pre-pandemic budget expectations. That survey conveniently ran in very early 2019 before the pandemic, or very early 2020 before the budget really took hold. So we have a very good view on what the underlying demand is for the market, or how people intend to spend. And then we did the expected multi-year effect of the pandemic by vertical market. What's going to be the effect on, say, automotive? What's going to be the effect on biosciences? What's going to be the effect on national research? That was our primary consideration. Then we checked that against secondary models by product segmentation, regions, and other subcategories to ensure consistency between the models, and to do a reality check and rectify the totals so that all the totals come out the same. It's no good if one segmentation doesn't add up the same as another segmentation. Does it make sense? We checked it against another SNAP survey that we did to our end users about budgets and what was going on. Now, this is all changing very quickly. And then we calculated the total loss, or in some cases gain, by segment, translated that into a revised forecast. And this is some of the high-level notes on what that looks like. For 2020, the worldwide HPC market is going to be 10% below the baseline forecast. Note that that doesn't mean a 10% drop year over year, because we were forecasting growth. We wipe out that growth, we're going to be $4.2 billion below what we had forecast, and that's going to be a 3.7% decline year over year, which is the first year of market decline since 2009. Now, this is a forecast. The actuals could wind up a little different, but as of right now, Intersect360 Research is forecasting a year-over-year decline for the first time since 2009. Most of that revenue is delayed, not lost. So 2021 will be a rebound year, 8% above our previous baseline forecast. So you take the growth into 2020 that would have been forecast, the growth from there into 2021 that would have been forecast, and then we hit above that. That means we have very high artificial growth from 2020, which is depressed, into 2021, which is a rebound year, which I know is going to get confusing. Then we'll have those echo effects in 2022, below baseline forecast, above baseline forecast, by smaller amounts before we return to quote unquote normal in 2024. Now, this isn't to say what we're doing is projecting that the pandemic continues to have an effect that long. This is just what happens from the significant pandemic effect in 1 year, that bang, it causes these ripples over the course of multiple years because of the long-term budgetary effects. This translates to $1.2 billion in real revenue loss over the 5-year forecast. And the reason for the revenue loss is because if you look back on this chart, what happens is the troughs here are deeper than the peaks are high. So even though it doesn't change the overall vertical market, the loss below the forecast in 2020 and in 2022 are bigger than the spikes above the forecast line in the odd years, 2021 and 2023. So there is $1.2 billion of revenue that's lost, that's not captured back. But we do get back onto the line in 2024. Now, there's significant risk to this forecast that I've already talked about. How long does COVID-19 last as an economic damper is the $6 million question, or in this case, the $1.2 billion question. And that's just difficult for us to forecast as HPC geeks, not epidemiologists. We're going to do the best we can with the knowledge we have right now. I'll quickly talk through some of the effects by the different segmentations, then I'll be available for questions. I'm going to do vertical markets first, because that's our primary segmentation here. You can see at the top level what the market looks like. The hardest hit vertical markets here in 2020 that then have to rebound in 2021. Energy, top of the list, which was already dealing with the suppressed price of oil prior to the pandemic, now is dealing with people not driving. The price of oil famously went to zero on some futures briefly. It's not really that oil has no value. Relax about that. Long term, the price of oil, we think, regresses to the mean. It comes back. But energy will have a big shortfall in 2020, followed by the rebound in 2021. Go back to what I said about the first thing that happens is if I don't have revenue last year, then I can't spend money. The revenue shortfall translates directly into HPC spending. Retail is going to be another big loss from a percentage basis. And then in terms of larger commercial vertical markets, the large product manufacturing that's looking at cars and airplanes, that's going to have a bigger effect. And you can start to see here why we had to do this by vertical market, because when we look at the economic effects of the pandemic, they really translate very differently according to the different vertical markets. Now, biosciences, with that pharma area, actually is a slight increase over the 2020 base. There's money flowing into pharmaceuticals right now. There's an increase in pharmaceutical research based on COVID-19. Same thing basically for national labs, national agencies. Those are getting a little bit of an influx due to COVID-19. So the whole government sector is actually relatively stable throughout this. It's not going to have the vast swings that certain commercial vertical markets have. Products and services, The same pattern because it all adds up to the same totals, like I was saying before. Servers are going to be the hardest hit area in 2020. Servers and also storage is going to be pretty significant. Now, it's worth saying here that that has to do with how budget effects start going through the different spending areas. Imagine I'm an HPC user and I have to take some cut to my budget. Let's say it's even a 10% cut to my budget. Okay, the first thing that end users tend to want to do when they have a budget shortfall is preserve existing operations. And that shows up in a couple of ways. First is people. I'd rather not lay anyone off if I can avoid it. I'm paying for them out of my HPC budget. I'd like to preserve my staff. And I'd like to preserve running the HPC systems I already have. So things like power, cooling, co-location, or floor space costs are baked in part of the budget that I'm not suddenly going to say, yeah, I don't want to pay for the space for my servers this year. I'll throw away the servers so I don't have to pay for the space or the power or the cooling. The existing systems tend to keep running. So if I have a 10% cut, but I don't cut any of these other areas, which aren't even part of the external spending model, that means that budget cut gets disproportionately translated into the external spending. And within that, new acquisitions, oh, I'm going to go buy a new cluster, I'm going to go buy a new storage system. Those get hit hardest of all. So that's where we see the biggest part of the shortfall, and that should come back in 2021. Cloud does the opposite, because when I delayed my on-premise purchasing for the new servers or the new storage, well, I can make up the gap with cloud computing if I have some project that really needs to be run. Not to the extent of, hey, I would have spent $10 million on this thing, I'm going to go spend $10 million on cloud instead. Well, no, if I was going to do that, I would have bought the thing I would have bought. But some of it gets, I'm going to delay the $10 million, but maybe I'll spend $500,000 or $1 million in cloud or $2 million in cloud. So some of that comes back in cloud computing, which is to say cloud is going to follow the opposite of everything else, because cloud handles the uncertainty really well. Cloud is going to grow well the more things are uncertain. So as much as we're already forecasting double-digit growth in cloud in the baseline forecast, forget the pandemic. When we build the pandemic into the forecast, cloud's going to have huge growth in 2020 because it picks it up on the uncertainty factor and picks up some of that gap. So we're actually forecasting enormous growth in HPC cloud in 2020 while everything else shrinks. 2021, cloud should be stable while everything else bounces back. So cloud continues its growth rate of over 20% and tends to have the opposite of the effect of everything else. When everything else is suppressed, cloud will grow. And we're continuing to model some of this growth in services and other related to those cloud-like environments. We might make some methodology changes to how we report that. Now, when we get into other long-term forecasts, eventually we're going to do 2020 actuals. We'll do a new growth rate up to 2025. We might decide to keep the base of the CAGR as back at 2019 and do a 6-year CAGR, because if we base the compound annual growth rate on an artificially low year, the CAGR is going to look too high, right? It's going to get deflated. We might keep that baseline on 2019 for several years as this plays out. Regions, there's not a huge effect that's different by region, but it is worth saying that the biggest decline right now is in US and Canada, and that is the opposite of what we thought it would have been when we first gave our guidance that, hey, this is coming back in March. In March, we would have thought the biggest effects were going to be in Europe and Asia. By the time we put the guidance out in July, the opposite is true. The bigger effects are going to be in the United States, based on there's been more recovery in Europe and Asia than there has been in the US. Hopefully it all starts coming back worldwide in 2021. Okay, a couple of interesting things I'll just mention is that our research goes well beyond the forecast here. We've done a broad end user survey on user vendor ratings to measure things like satisfaction, loyalty, future outlook. We're delivering that data to our clients now, and we'll be able to do a future webinar based on that, but we need to give our clients a head start on that data. That's been a very interesting survey to get that in, and already has some interesting findings, some of which are creeping out as our vendors who've subscribed to that survey are quoting certain data points. Which vendors have the best impression, satisfaction, user community loyalty, willingness to buy again, which vendors are likeliest to see shifts in market share based on that user sentiment. All of those are answered in that survey. These are the vendors that we measured across 4 different modules in processors, servers, storage, and cloud. We can take a look at what the end user views are of all of these vendors in this space. Where we'll be coming up next, if you want to catch more presentations from us, we're going to continue Intersect360 Research, our partnership with the HPC and AI Advisory Council. These conferences, I'm labeling them by geography. That's who's hosting them. But we're going to be here in my home office again. You'll see this same background for the conference that I would have gone to Australia for the NCI September 1st and 2nd. Now September 1st and 2nd, that's August 31st and September 1st. If you're me, that'll be the evening or late afternoon of those days, but September 1st and 2nd in Australia, and then the STFC conference in the UK, October 13th and 14th. Also supporting, continuing our partnership with Tabor, HPC on Wall Street, September 14th and 15th. Really look forward to that virtual event. And SC20 has announced that it's going to be virtual as well. We won't be in Atlanta, sad to say, November 16th through 19th. Watch for us and more presentations during and around SC20. Thank you very much for tuning into this webinar. Conclusions: demand for high performance computing is continuing to endure. It's a long-term stable growth market, regardless of COVID-19. Dynamics that we're shifting toward include an increase in cloud computing and other cloud-like deployments, an increase in government spending. COVID-19 is actually accelerating both of those trends. Vendors in this community should just expect purchases to be delayed in 2020. However, that will be followed by a boom year in 2021 as sales come back in. Not all of the lost revenue gets recaptured. And I have to continue to emphasize significant risk in this forecast based on 2 significant factors: how long COVID-19 persists as an economic damper, and the health of HPC vendors and their ability to ride out market instability is going to continue to be a factor in market shares. Thank you very much for joining me for this webinar. I'm now going to turn to some of these questions. Starting with, how does Intel 7nm slip affect the HPC market forecast? We covered that in a recent podcast, This Week in HPC. Doesn't really affect the HPC market forecast. It affects one major system, of course, the Aurora exascale supercomputer. We're going to continue to watch that. But the reason it doesn't affect the overall forecast is because we found that most users will buy systems in the year they're going to buy them, and it's rare that a customer will delay a system by a full year based on, I'm waiting for this one specific thing. There will be some individual government systems that do get tied to that, but not so much that we're really making a change in the forecast for right now. Can I speak to the growth rate of Dell? Well, Dell has been a major growth vendor in this space. Now, all of the large vendors had depressed growth this year, and Dell had a slight decline year over year. But Dell is a major vendor in this space. I've heard comments before about they don't really play at the high end of the market. I found that to be false. We don't see them in some of the exascale conversations or the government lab supercomputers. But I said recently in a podcast and on Twitter that I thought it was noteworthy that Dell is now the vendor behind the largest supercomputer in academia, the Frontera system at TAC, as well as the largest system in Industry, which is the any supercomputer in Europe. Both of those are top 10 on the top 500. So any illusion that Dell isn't at the top of the market, I think is misplaced. They're going to be duking it out with HPE for #1 share in servers for a while. Although, as I said, I think HPE is going to get a real bump from Cray, particularly in government sales and during the run up to exascale. Can we share market share information for cloud high performance computing, AWS versus Azure, GCP, and others? Most notable others in that case are going to be IBM, Ali Cloud, OCI, his Oracle Cloud Infrastructure, of course, has had a big launch year. We're not reporting those shares at this time because of a lack of reporting from those vendors. However, we do model those, and we report those as part of the vendor profiles on those so you can read some of that in the specific reports. AWS is #1 by a healthy margin, followed by Azure with a healthy margin over GCP as #3 by a healthy margin. I won't give the exact percentages that we're modeling as part of this forecast or part of the market sizing, because we reserve that for our clients right now. But I will go ahead and say publicly on this webinar that it's AWS, followed by Azure, followed by GCP, followed by everybody else right now. And some of the market sentiment that we saw in that survey I mentioned also lines up well with that. Regarding HPC storage market revenue share chart, to produce a similar chart for storage vendors focused on HPC and AI performance. So that would be, taking out, I presume what's meant by that question is taking out enterprise storage products that aren't necessarily targeting HPC. And the answer is no. We don't produce a similar chart around that. We look at revenue share for what's running on HPC regardless. Now, if we get down to what people are really thinking of as high performance computing storage, the better place for you to look might be our site census survey on storage, where people tell us what they have installed. That's where we see vendors like DDN and Panasys take a big jump up in what people report as their storage hierarchy, as a real indicator that people think of DDN or Panasys or other storage vendors like that at a much higher rate than they tend to think of a NetApp or a Dell EMC or HPE when they think about what their HPC storage is. So if you're really trying to get at a notion of what people think of as high performance storage vendors, that would be one way to do it. And then of course there's our customer sentiment survey, where people are rating HPC storage vendors. I think you'd find that DDN does very well in that as well. We'll probably get a little more relaxed about reporting some of those things after our paying clients have a chance to digest that. We tend to give our clients a little bit of a head start on some of that data before we do it in a public webinar. Will we share the slides with the audience? Yes, there will be a recording of this webinar available. And if you'd like the slides, please feel free to contact me directly, addison@intersect360.com. You can hit our Twitter handles at Addison Snell, at Intersect360, our podcast at This Week in HPC. Let us know, and I can get you a copy of the slides. These have been presented in a public forum. Also watch for our announcements on video playback. To avoid skewing of data noted by me, would 5 years be enough time to use 2019 as the baseline CAGR, or would we see a longer effect? That's kind of what I was talking about in terms of the baseline effect in the market. 2019 we can consider to be a stable year. And then 2020 and 2021 are going to be the oddest years. So when we get to 2020 actuals, when we do a 5-year forecast out from there, we'll do the 5-year forecast out to 2025. But when we measure the compound annual growth rate, it will probably be most accurate to do a 6-year CAGR, 1-year trailing and 5-year forecast based on 2019 base, to keep it from looking like this really high CAGR based on a low 2020. So that was the methodology I was trying to describe. If you have a further question about that, feel free to hit me directly. thoughts on, how do I get signed up for HPC user surveys? Let me know, and we'll put you on our list. We would love to get your involvement. If you're a buyer of high performance computing resources, we would love to get you on our survey list and get your views in the market. Thoughts in ARM in data center? Well, like I said, we haven't been measuring direct market share there, but ARM is certainly having a major effect. And we looked at the ARM vendors with respect to that survey there. Now, ARM, remember, it gets fragmented across multiple different vendors. We're seeing, that previously would have been Cavium. Marvell was kind of in that top position. Now we're seeing a lot of attention around A64FX, predominantly from Fujitsu, but also Cray picking that up into their product line, both in some current HPC Apollo products that aren't under the HPC Cray brand, but presumably also into some HPC Cray branded supercomputers in their roadmap, although the details of that haven't been announced. That's more of a analyst opinion that might happen going forward. ARM is going to have a significant effect on the market. And of course, there are also comments about whether NVIDIA is going to buy ARM holdings. I think ARM is a significant potential partner for NVIDIA. The dynamics of the processor space here are gosh, they're going to just have a huge shakeup over the next couple of years. And I could do an entire separate webinar on the inner dynamics between Intel, AMD, NVIDIA, the ARM vendors, FPGAs in this space. I would refer you to the vendor profiles that we published on Intel, AMD, and NVIDIA, which are available on our website. And there's ARM commentary in all of those based on Fugaku and other systems. I think it's inevitable that we'll see the share of ARM, or at least the trial of ARM, continue to rise in this space, but it has not been a high volume part of the market yet. So a lot of it is just that trial. There are going to be a lot of eyes on this Fujitsu Fugaku system and what they do with HPC applications, and how much of that translates now down to more HPC throughout the market. I think it's extremely noteworthy that out of the major exascale plans out there, there are several that are based on ARM, and there's only one based on Intel right now, which is the Aurora system. And we already talked about the 7-nanometer delay there. So I think there is significant risk for Intel. There's significant risk for all of the vendors in this space. I don't think anyone has anything locked in, and there's going to be a lot of movement in this space in the coming years. Notice we didn't call out hyperscalers in this. Yeah, this was about the HPC market model and forecast. We haven't released any numbers around hyperscale at this point, year over year. We have had some commentary around hyperscale, particularly based on our previous comments from the forecast, that the amount of power and influence concentrated into the tier 1 of hyperscale is unprecedented in the information technology era, and really has not been seen in worldwide markets of any type since the late industrial revolution. And now what we're seeing is leaders of some of the top tier hyperscale companies testifying before Congress. I think that's the biggest threat to the hyperscale market going forward. But regardless, I should say, outside of some major shift in either regulation or public sentiment, we're going to continue to see public growth concentrate more and more into that top tier of hyperscale companies, with more than 10 companies that spend over $1 billion per year on hyperscale infrastructure, and getting up into the multiple billions of dollars per year. So yes, we are continuing to watch that, but we didn't cover that as part of this webinar. Convergence of HPC and AI, my view of what that means to traditional HPC and what changes it drives. I do think these are converging, and AI, of course, has been one of the major underpinnings to the growth rates in high performance computing. I think these are converging in the sense of we're going to see machine learning have an influence of how we think about high performance computing applications. I love that it's driven conversations, for example, in terms of precision. When is it appropriate to use double precision floating point? When is single precision enough? When is half precision enough? There are situations where I think we do very expensive double precision calculations on models that aren't that good to begin with. If we can use lower precision machine learning to help refine models that we then do better precision double calculation on where it's appropriate, I think that's the kind of merger of HPC and machine learning that's really appropriate in this space. I'll call out a couple of other specific ideas of just things that we might see. We've talked about person in the loop, engineer in the loop, for a long time. It hasn't really taken off because of the human latency there of having a person interact with a multi-physics model. But what about AI in the loop? That's an idea. If we can teach AI the rules of a game like poker or Go, we ought to be able to teach AI the rules of a game like optimize the airplane wing and give it the rules of the game. Here are the structures you have to work with. Here are the basic shapes. Go iterate on this and come back with ideas. Can you have machine learning help find the ideal molecule, right? We ought to be able to train AI in these different areas, which doesn't diminish the need to do the deterministic science, and in fact amplifies it, right? These become recursive, where you need more deterministic computing to support the predictive computing going into the AI workload. So I think we're going to see both. That's an idea. Many people use the phrase HPC. Can you define how you use it in our research results? We're looking at, Chris Willard always liked to use the shorthand systems bought by scientists in engineering for science and engineering. And I think that's pretty good, although it does get into other high performance areas, like in, for example, finance. Do you count that? Do you count economics as a science in this space? How picky are you being? Really what we're looking at is parallel computing applications that require at least 2 nodes, and they're stressing the system in some dimension of computation, memory, storage, networking, I/O, etc. And we have definitions around what is HPC, not only in our surveys, but also on our website. So I invite you to look that up there. That said, we run a survey. The end user hopefully has an idea of what they think is high performance computing. We try to update that as people's definitions evolve as well. We think we've been through grid computing and cloud computing and clusters, and there's a lot that starts changing in the market, and it's impossible to say, well, this one thing is a high performance computer and this one thing is not. It really gets down to how those systems are used, and that's what we're trying to capture in our market methodology. It would be interesting to see what Intersect360 finds out about the growth of ARM-based technologies and players into the HPC market toward the next few years. I agree. That will be interesting, and we're going to continue to research it. We'll continue to report on that. We report on those vendors. We report on the systems that are bought. We've got the ARM vendors in the vendor survey rankings that end users have done. It's a hot area. We're going to continue to monitor that. Are you noticing any traction from Kubernetes to pull HPC into the data center? That's interesting how the question is phrased. We are seeing increase in containers in general and Kubernetes specifically as enterprise use cases for high performance computing. That, I will admit, was one that took me by surprise as an analyst when containers started really getting traction a couple of years ago with Docker. And that was because high performance computing historically has always been pretty allergic to any form of virtualization or overhead. And I didn't really see where containers were going to take off. But nevertheless, they have. And Kubernetes is the most common deployment. We also see Mesos or Mesosphere, and of course Docker a little more in the academic areas. They do have a good affinity toward cloud because I can lift and shift a common environment around to a remote resource and get what is a big deal for HPC, which is reproducibility of results. I think that has a major use of containers there. So that is something that we monitor. Now, in the question, is it said that helps pull HPC into the data center? Hmm. I'm not sure about the causality on that, whether it's Kubernetes that's pulling HPC into the data center. I think it's more like cloud and other forms of or virtualization are pulling Kubernetes or containers in general into HPC, and that's where we're seeing some of the merger. But the causality is hard to get at. We are seeing the correlation. Yes, let's do that Chips War broadcast. All right, we'll keep talking about chip. I hope you'll subscribe to our podcast, This Week in HPC. You can find that on our website. You can find it on iTunes. You can find it on SoundCloud. We distribute it in partnership with HPC Wire. This Week in HPC really keeps up on a lot of these ongoing changing trends, and it's where we put out a lot of our opinions on current events and what's going on in HPC. I think of it as my blog. I'm normally joined by Tiffany Trader, who's the managing editor at HPC Wire, although we do have other guests from time to time. And while I'm talking about the podcast, I'll take a moment, this wasn't specifically asked, but any of you who are still on, please go check out the special video panel that we did on racism and high performance computing. We talked a lot about COVID-19 in this podcast. The other major news story of the year has been race relations in the United States and worldwide. And we found that we just find blacks to be significantly underrepresented in high performance computing, and there is a digital divide there. I was delighted to be joined by prominent Black American leaders in high performance computing. We did a special video panel episode on that of our podcast. You can find a playback on our website, on our YouTube channel, on HPC Wire. Let me know if you can't find it. If you do video racism in HPC search, I hope you would find it there. It is well worth an hour of your time to go listen to the stories and perspectives brought by these leaders, including what I find to be an interesting question. We talked about where can we use AI in high performance computing. Valerie Taylor of Argonne National Laboratories was quite articulate in pointing out that this is an area where we have a lot of data. We're supposed to be good at finding patterns in data. If HPC is about grand challenge problems or solving the world's toughest problems, we hear that a lot. Here's systemic racism. What is HPC doing to help address systemic racism? And is that an HPC application someone should be running? I'm very interested in the answer to that question, and I really appreciated these leaders' views, perspectives on topics such as that. Okay, rise of containers in HPC. I should have mentioned Singularity earlier, of course, as an HPC-focused container. I did not mean to leave that one out. Sometimes when I start rattling off examples, I leave out something that's noteworthy. Singularity has certainly been noteworthy in this space. Someone else mentions Charlie Cloud, which I have not been tracking, Docker, etc., Kubernetes. We now have both standard batch workload managers, Slurm, PBS, LSF, and Kubernetes. Paradigm shift. What is my view of the timeline, impact, et cetera, of composable systems that also include edge? I think this is, an ongoing discussion. Composable systems to me is almost an evolution out of things that we've talked about with software-defined deployments, for example, or just the merger of HPC and the data center. I think people are going to continue to look for that. That will be an ongoing discussion. I don't see it as an overwhelming trend because the countervailing trend that's going on is the pendulum is swinging back away from generalization towards specialization. And that's part of the interdynamics between processor vendors. It's part of what we're seeing with smaller vendors gaining traction on larger vendors. And if there are things like composable systems, I think there's also things like specialized systems that are getting driven into the market. And that really becomes the dominant trend in this space. And it's not to say that anyone can't create composable systems. I think that's admirable research and it'll be ongoing, but I just don't see it as the prevailing trend that we're going to see continue to come through high performance computing. Okay, we've gotten to the end of all of our questions. I really appreciate those of you who hung in there through an hour and a half of not only presentation but Q&A. I was delighted to be able to join you in this virtual environment. I'm sorry that it wasn't more interactive in what's essentially a one-way webinar format, though I'm glad I was able to address so many questions. I think we can survive taking a gap year on the HPC conference circuit. We've been able to do a lot of work here at our home offices, and we're grateful for our support of our users who participate in our surveys, those of you who listen to the podcast, and of course our clients who pay for our research. Please continue to keep consuming this content. I will see you in virtual events over the course of the rest of the year and hopefully back out live face-to-face in 2021. Thanks for tuning in.